Right. I think Rob, let's get cracking for the sake of time. I know a lot of people have got plenty to do. So first of all, just to say to everyone on the call, a very warm welcome. Lovely to have you all here. I'm quite sure that the presentation today is going to be very informative. I know there have been a lot of questions around what is going on in the markets at the moment. And so I thought who better than to ask to come and talk to us than none other than Rob Enslin from Linked Investment Managers. Many of you will actually have Linked as part of your investment portfolio. And Rob, as a student of the market and someone I admire and respect hugely, not only for what he's achieved, but also for his opinions. I think he has a very insightful understanding of the markets. And certainly having seen this presentation last week, something I think that a lot of you can really benefit from as well. So Rob, without further ado, I'm gonna hand over to you. Thank you.
Thanks very much, Giles, and thank you to all of you for making the time this evening. I'm sure your time is precious. I'm going to try and keep it as punchy as possible and leave a couple of minutes at the end to answer any of your concerns and questions. I think it's fair to say that we started off 2022 quite differently compared to the last decade, if I may. Generally, we've had a very strong start to markets post the start of this year. And understandably so, many of you are looking at your portfolios and wondering what on earth is going on and trying to understand things. And then these types of environments can be quite unsettling for clients. And hopefully I can dispel some of the myths at the moment, and then at the same token, appreciate some of the real risks that are inherent in the markets at the moment and things to avoid. So yeah, like as I've just alluded to, we certainly started January quite, we love to use the word volatile, but that basically means the markets have been off as we've started the year. This was as of the end of the 28th of January. Post that, we had a few good days, and I think today is going to be quite a rough day on the market once again. Post some big company results. We've had results from Meta, the former Facebook. We've had results from PayPal. So you've seen some numbers that have disappointed market expectations. I just want to make the point here that they're not bad numbers in the sense that these companies have suddenly become unprofitable and unstable businesses. They just haven't been as good as what the markets were hoping for. And the elastic band in my mind is stretched so far that when you just put a little vibration on it, it's quite significant. When the elastic band is very loose, i.e. valuations are a little less punchy, the vibration through that is a little different. But just to give you some context to the numbers, the clear loser year to date has been the NASDAQ, the sort of higher growth beneficiary business models that have really outperformed over the last decade. NASDAQ at that point in time was down 12%. As of last night, we were down around 7%. I would expect us to lose about 3% tonight or so. Equally, the Shanghai has been down 7.7, the Nikkei down 7 odd, S&P 7 odd, DAX, and the European markets around the 3 handle. And the only sort of two standouts there is first and foremost the Hang Seng, which has been holding on to a positive gain, and the FTSE, both for very different reasons. The FTSE, I think, has been a net beneficiary of a higher oil price. We've seen oil stocks doing very well, or energy stocks doing well, and they have a big component of that on their market. And then for different reasons, the Hang Seng, which went through quite a turbulent 2021, as the Chinese regulator stepped up regulation and created some uncertainty. That sort of headwind seems to be loosening up a little bit. We've seen GDP prints out of China and various economic prints that have been quite dire. And the belief in the market right now is that the Chinese regulator going into 2022 is going to have to sort of open the taps with regards to lending, etc. So it's a far more favorable backdrop compared to 2021. I also want to make the point that this is a very short period of time to make conclusive views from. If we turn our attention to the 2 blocks on the right of your screen, just to give a little bit more context to the numbers, and first of all, the top block looks at equity markets by way of the MSCI World, and it breaks it down 2 paradigms. So it looks at market caps, so large cap companies or sort of mega caps, your mid-cap size businesses, and then your small caps. And it also looks at it based on various investment styles. So we talk on the left-hand side about value-orientated companies, companies that are often associated with old industry, things like industrials, things like financials, things like energy. And then on the other side of the spectrum, you've got growth-oriented businesses, businesses that have high earnings growth projections going into the future. Now, over the last decade, the clear winner has been growth-oriented businesses for various reasons. I think one of the reasons is you obviously want to pay more for a company that's growing as opposed to the other. But secondly, the economic backdrop has been highly accommodative. And what I mean by that is interest rates have generally been very low and stable. Just over this very short period of time, you can see there's been a big rotation away from growth into sort of value-orientated styles. And that's been the flavor of the month-to-date type performance. This presentation is more equity focused, but it is worthwhile pointing out that there hasn't really been room to hide. Traditionally speaking, you buy bonds against your equities if you're running a balanced portfolio, because what happens is generally in a sort of a weaker environment, interest rates go down and there's a capital appreciation event that takes place in bonds. So that acts as a nice hedge or offset against your equity portfolio. But not at this time around, or this little short period, is certainly not working in that vein. If you take something like US sovereign debt, which is considered to be the safest debt in the world, your longer dated debt, your 30-year investment is down 3.75%. Now that's a big number, but at the same token, you may say, well, it's not such a big deal compared towards equities. In bond terms, that is an astronomical loss over a very short period of time. So I think it's fair to say that we've started the year off on the wrong foot. So what is really behind what we're seeing at the markets right now? And I think there's lots of noise in the system, but at the heart of it, from our investment team perspective, the big change that has happened quite quickly has been the expectation from the market as to what central banks are going to do to fight inflation. We've seen inflation generally quite stubborn throughout 2021. At first, the rhetoric from central banks as well as the investment community is that it is transitory, meaning that the expectation was in the second half of 2021, inflation was projected to level off and come down. And why most of the market believe that, including ourselves, was we've seen massive structural bottlenecks as a result of COVID-19, the pandemic. So, because you've locked down economies and you've forced people to the lack of mobility of people, there's been a massive lockup of the movement of things, which has created inflation from the supply side. The expectation was that as you grease the wheels of the economy, global trade would start to move back to normal patterns, and therefore inflation would come off. What surprised all of us, or many of us, and certainly it's priced in the markets, was that the Fed came out in December with minutes post the equivalent of our SARB meeting, the Federal Reserve's MOC meetings, and they painted in those minutes a far more hawkish or aggressive outlook on inflation and therefore interest rates. And then again in January, their first meeting that took place earlier or last month, the rhetoric and the conversation in the interview was very hawkish towards the Fed's dealing with inflation. So to put that in tangible numbers that we can all kind of understand, on the 1st of October 2021, we were all pricing, or the market was pricing in one interest rate hike for the US for 2022. That's still the expectation was a very accommodative runway for this year that we're in right now. As of the 1st of January, that sort of backdrop of view changed quite significantly. Post that meeting, we suddenly were pricing in 3 interest rate hikes. And after the Fed spoke in January this year, we're now expecting 4, with some market participants expecting 5 interest rate hikes for the year. And this is not only a US Fed story, this is also other major central banks sort of conversation at the moment. We've had both the Bank of England and the ECB talking. ECB is on a little bit of a different trajectory. From an ECB standpoint, we're still only anticipating, if not no interest rate hikes, maybe 1 interest rate hike for 2022, whilst the Bank of England actually got going last year in December and surprised markets with a 25 basis point hike, and again today with another 25 basis point hike. And for us, or many of us on this call that are South Africans, wondering why on earth would the South African Reserve Bank go ahead and hike interest rates when we all live in this economy and understand that it's on its knees? Well, it is somewhat of a relative game, because if we don't hike interest rates on a relative path whilst appreciating growth, we would find ourselves in a position where the rand has big risk of blowing out. So part of price stability is ensuring that sort of step is in the same direction. So if you ask me quickly what I think the SARB does, I think the SARB hikes interest rates 75 basis points this year. We've had our first interest rate hike again in January. That is, I think, what I've just discussed at the heart of what the concern in stock markets is right now. But then there are also some other sideshows that are taking place. And I use the word sideshow cautiously because it's something to be aware of and it can escalate into something serious. We would have all picked up in the media that there are tensions between the Ukraine and Russia, with the likes of NATO and the Americans being forced into a position to firstly pick sides and also stand their ground. So why is this important? Because really a very important pipeline that runs across the Ukraine is the main supplier of energy into Europe. So assuming the worst and Russia does ultimately cross that boundary and step into Ukraine, that could have some dire effects towards energy and therefore amplify this inflation concern that we are witnessing right now. The reason why I say a sideshow, because often what we've seen in the past is that in the moment, geopolitical tensions have heightened volatility and concerns on markets. But if we go through history, other than us going into a full-blown world war, they do often equally tend to blow over quite quickly. So as an investment team, we're far more concerned about the inflation outlook and how that plays out, as opposed to the geopolitical tensions, but we are keeping an eye on this because we do know we live in quite a fluid world at the moment. So with that backdrop, I hopefully haven't shocked you too much, but should you be panicking as a client? I've just painted a very different outlook to what we've gone through over the last decade. And my immediate answer is no. And just to sort of set the scene, what I've put on your screens is a look at the S&P 500 over the period post the financial crisis, which really ended on the 9th of March, 2009 to date. And the point here is that there have been numerous reasons to panic and to sell your portfolio or to try and move into cash and all those types of moves, market timing, etc. And the reality is investing in markets is a risk-taking exercise. And there are always risks. Some risks are bigger than others. Some do materialize into momentary losses in your portfolios, and others the market look through. And I would argue we are going through such an event as we speak right now, with inflation as the headline, if we had to categorize what we're witnessing right now. And with that sort of comment, I'm showing you, I think, probably one of the more powerful slides in my deck. And it looks at the S&P 500 over the last 40 years. And often we don't realize this when we're in the moment, or our rearview mirror memory tends to fade. But markets are actually a lot more volatile than we realize. If we look back over these last 40 years and we look at what the market went on to do, represented by the blue bar, i.e. in 1980, it was up 33%. The little green sort of with the white inside, it represents the lowest point that the market was at in that given year. So it's not to say that just because markets pull back, the year is doomed and you're unlikely to have ultimately a good outcome in your portfolio. Drawdowns are part of markets. Unfortunately, I wish they weren't part of markets, but it is part of investing. And just to give you one or two prints there to give you some context, back in 2018, the market at one stage in time was down 19%, ended the year down 4%. As we were all understood in 2020, the market at its low point was down 34%, ended the year up 18%. And you can go back in time, and unfortunately, this is part of investing. And just to give you something more to hold on to in that regard, looking at the same type of information How often does the market pull back and the extent of that? So the market generally pulls back 5 to 10% every 10 months if we go over extended periods of history. It pulls back between 10 and 20% every 22 months, and it pulls back by more than 20% for every 56 months. I think we've been the backdrop that we've been in the last 3 years has been somewhat benign, and we've forgotten about this fact. Equally, the market, when it pulls back by 5% or more, there's 11% probability that it pulls back by ultimately more than 20%. And there's a 28% probability that it goes on to a 20% pullback if it's down 10% or more. So we are in probably that camp at the moment. There's a 1 quarter chance, give or take, that the market can pull back further than we are right now. I mean, when we got to the bottom on the S&P on markets, we were flirting with that 10% number. Maybe to take some comfort from that is to look at the right-hand side. And as much as markets are, volatility is part of markets, recoveries are equally an important caveat to that. And hence why we always say to our clients in these type of environments, the worst thing you can do is go and crystallize your portfolio by locking in those losses and cashing in. Because in history, almost always the markets have recovered and they've recovered actually in quite fast time. So we look at how long it's taken for the market to come back 5 to 10%. You can see there in 3 months, there's a certain probability and we go on. So the point I want all of you to take on this call is that the worst thing to do in a market pullback is to go and panic and cash in your portfolio. Secondly, I painted quite a negative backdrop on interest rate hiking cycle, and you probably were thinking, well, geez, that's certainly not the environment I want to be investing in. And just to hopefully calm, I've named this slide, keep calm and carry on. Interest rates do not have a direct correlation with poor market performances if you go back in history, and I think this time will be the same. If we look at, again, previous periods where the Fed hiked interest rates, what asset prices went on to do. If we look at the S&P GSC index, which is the Goldman Sachs commodity index, that achieved an annualized return of 19% in that environment. The emerging markets did 16% per year. Japan did 14%. Gold does around 11% per year. Europe, represented by the stock 600, has achieved a return around 10. The S&P 500 around 8%. So yes, there is a requirement in an interest rate hiking cycle to make some strategic allocation changes to your portfolio, but it's not an environment where we would recommend completely flipping your portfolio around and running for the hills at all. Just very briefly, what we're looking at now is just the performance of 2020 versus 2021. It does feel like a lifetime ago away, but just to give you some context, 2021 was all about risk assets. If you were generally in risk assets like equities in developed markets, there was follow through in both years. You achieved a decent rebound post-COVID, and the follow through came through quite nicely in 2021. Equally, whilst we're seeing this big reversal from growth into value stocks, I do want to point out the fact that, you know, in absolute terms over the last 2 years, growth has outperformed value. So has it outperformed value over the last decade. In terms of our belief towards markets, we do need to be balanced. So we're not going to stick our heads in the sand and say that we're not seeing this value trade that is playing out in the market. But at the same token, at the core of our beliefs, we prefer to buy high quality businesses that continue to grow. If we look at some other asset classes that came under severe pressure in 2021, that was lay more on your fixed income orientated investments. US investment grade debt, for example, ended the year negative. US treasuries ended the year negative. And that has been amplified as we've gone into this year as the probability and the velocity of interest rate hikes has increased. Very briefly, just to give you a backdrop, as of the end of December, how did all of our portfolios handle up? I think it's fair to say compared to prior years, we didn't have this big alpha year by massively outperforming our benchmark. But across the board, across the mandates that we run, whether it's cautious mandates, balanced mandates, and growth mandates, we hung on quite nicely and we're more or less in line with our benchmarks. What's of far more relevance to us is how do we manage our way going forward and with the mindset of a long-term investor. As we've always said to our clients, we have no control over return. We have control over risk. We're risk managers at the end of the day. Returns come with that. And for me, an important takeaway on this slide is that our sort of longer dated performances, 5 years and since inception, we've comfortably outperformed the average manager in the market across the board. For those of you that are in the share portfolios, which I think a lot of you on this call are, you'll see that we actually had a fairly decent year compared to some of the markets. And the longer term track record remains very strong with an annualized return of around 16.8%. The picture remains quite similar in the SA market strategies, so your retirement annuity type strategies or your compulsory money. Our picture remains quite similar. Thankfully, from a South African standpoint, after probably 5 to 6 years of disappointing returns across the board, not necessarily from our side, but just from an asset class perspective, we've actually had quite a strong rebound over this last period. A big beneficiary has been higher commodity prices, which has filtered through to our stock market as a whole. And then if you quickly ask me about the South African bond market, it looks quite different to developed markets. In our minds, it's actually very attractively priced. Our expectation for South African sort of 10-year bonds is around anywhere between 10 to 12% for this year. And if you compare that to where inflation is, that's quite a handsome real return relative to the risk one is taking. And then just very briefly, I actually asked Giles if we should just remove the slide from the presentation, but he said, no, please share it. There was an article circulating in CityWire about the best domestic balanced funds in the market based on consistency, because what we've often seen is funds that did very well in 2020 gave up all their gains in 2021 and vice versa. Some poor funds did well in 2021. Who are the managers that have done well in both years and looked at their track records over 5 years? So I just want to make this very clear. These are none of these managers I'm bashing. I think these are absolutely superb managers here, but it's just to provide some context, remembering that our approach towards investing is a multi-manager strategy. So we're not constrained by a single house view or a single fund. We have the ability to blend managers and find who's best fit for the environment we're in. And interestingly, by doing this exercise, I included all the 10 best managers that were included in the article and ranked their performance relative to ours. And we actually stand up, we've outperformed all of those managers. And then importantly, as I said earlier, risk is what we do. How much risk did we take to achieve those type of returns? And we're actually on the lower end of risk as well. So that's certainly, the point here is not to brag about our performance. It's more to say that the process we're following in management, we would argue is a smarter way of diversifying risk and being able to be flexible to the prevailing environment. Okay, so now moving a little bit on and looking forward into 2022. And usually I have a very long house view. I've got 1 or 2 slides here. I just want to capture it in a few points. So the backdrop that we've come from was on the one side very much as a bottleneck, slow economic recovery as we moved out of COVID, and what are central banks going to do type of conversation. And then coupled with that, we saw the Chinese authorities come out with their 14th 5-year plan. It's always a mouthful. In sort of March last year, which the follow through of that was very stringent, very aggressive and quick legislation and regulation into their markets, which had a massive impact on China, and that rippled through towards emerging markets. So you saw 2021 was about developed market equities doing very well, emerging market equities underperforming, largely explained by China's actions throughout the year. As we move into 2022, I think the sort of key themes that we need to be aware of and be watching quite closely is firstly inflation, which I've touched on earlier. Secondly, what are central banks' responses going to be? Because now we've got to the point where it's not about if the Fed, for example, hikes interest rate. The market's priced in 5 interest rate hikes. So now it actually comes down to, do they hike less than that number? Theoretically, they can't really price in more than 5 hikes. because I think they've got 6 meetings left. So it's either going to be 6 or less. And if anything, if we see an environment where inflation does start to level off a little bit and gives central banks room to say, okay, guys, we came out with a very aggressive stance earlier in the year, but subsequently things have played out, and therefore we're going to run this lower for longer environment, that would actually be a net positive and an underpin towards markets. But I think 2022 is about finding what normal rates and growth look like. If we look at the year and we break it into 2 halves, I think we see from our standpoint, our projections, we're going to see above trend inflation and growth for the first half of this year, followed by, we still think inflation starting to level off somewhat in the second half of the year, and equally growth following suit. Now, the conversation in markets is focused on inflation, but I think we do need to start thinking about growth, because the worst outcome, which isn't really being discussed much at the moment, is an environment where inflation remains quite stubborn, but growth starts to level off in the latter parts of this year into 2023, because that's the classic stagflation type of environment and tends to be quite a bad backdrop for most asset classes. We also do need to appreciate the fact, and the market has actually derated quite quickly, but we are coming off a very high stock valuation environment. Within the fixed income space, credit spreads are a lot tighter, and then we are walking into, regardless of the path, almost certain higher interest rates than where we've come from. So that requires a little bit more care and finesse in your portfolio construction, and the days of sort of buying just ideas and themes and things that sound good are less likely to succeed compared to the backdrop we've been in. From a volatility standpoint, unfortunately, we don't expect volatility to go away this year. I think we are in for this type of environment where we have these periods of pullbacks and equally these very excessive bounces that we've witnessed as we sort of transition into the second stage of the economic cycle. And I do think China and geopolitical tensions are going to add to that. I think if anything, the tensions between the US and China have been on hold, I would argue because of COVID. But as we move post a COVID environment, I think it's fair to say that those tensions that we went through with the Donald Trump administration could come back to the fore, maybe not in the same brassness that we witnessed with Trump, but it's quite clear that world dominance, that fight for world dominance hasn't gone away anywhere. So with that sort of backdrop in mind, we still think if we look at asset classes, what they're able to achieve relative to inflation, equity along with private equity markets and some infrastructure funds are best suited for that type of environment. And therefore, despite the volatility, we remain quite constructive on risk assets within a measured approach. And it sounds quite silly, but now more so than ever, we're encouraging our clients to be long-term focused, because if you're going to look at your portfolio on a month-to-month basis, 1 month you're going to be thrilled and other months you're going to be very disappointed. You need to have that long-term mindset and understand where we are and where we're going to. From a market expectations perspective, and there's multiple ways of looking at markets, but one of the more traditional ways is to look at valuations. So what I've put up on the screen here is your price earnings multiple. So your share price divided by the earnings per share to give you a sense of how expensive things are across different regions. So on the left-hand side, we've got the US, UK, Japan, Europe, the ACWI, which is basically both emerging markets and developed markets, the FE, which is the world excluding the US, emerging markets, China, and South Africa. Now, to explain this chart very quickly, the black sort of bars at the top end of the bar represents the highest valuations have been since 1995, i.e. the market's expensive. The bottom represents the cheapest the market's been. And then on that, where were we in 2020 by the sort of orange circle, and where are we now? And the general takeaway from this is that, first of all, markets have become cheaper than they were in 2020. And that's a function of earnings actually starting to come through. So yes, prices have gone up, but earnings have actually come through even stronger. So the market's looking slightly cheaper. And then equally, if we look across the board, other than the US, markets are looking, I would argue, fairly priced. Nothing there is overly concerning to me. With emerging markets looking, I would argue, very cheap. And then the standout has been the US. So the US is both expensive relative to its history, and it hasn't really derated as much as the rest of the world. So partially why there's been a harder hit on the US as in the last sort of couple of weeks is explained by valuations. All of us investment managers in the world look to find value, and the US stands out relative to the rest. I would caution only making an investment decision based on value. Value is one, as I said, one function of a good investment, but we do need to take into consideration that from an earnings momentum perspective, the US has still really strong earnings momentum. And then secondly, from a quality attribute, often more than not, some of those listed US companies have high degrees of quality, very hard to find in other places of the world. So what are high degrees of quality? It's very capitalized balance sheets. It's businesses with very powerful economic moats that are difficult to, to disrupt. Management teams that are very successful at allocating capital. Those are all types of examples of that. And a standout would be a Microsoft. So even if I had the ability to reproduce a better operating system than Microsoft, my penetration into the market would probably be limited, given how entrenched Microsoft is into the sort of global world. So I've just touched on equities. I think the backdrop for fixed income looks a lot more challenging. So what I'm showing you here is the annualized 10-year return expectation for the granular pieces of bonds. So high yielding debt, sovereign debt, investment grade debt across the board, and it's quite long. The outlook is 10 years. So return is represented on this axis, and risk measured by expected volatility at the bottom. And then I've said where was inflation in 2020, and why I use 2020 is because we're still waiting for the final bunch of countries to produce the global inflation number. But historically, inflation has been around 3.5% odd. We're probably going to have a higher number this year, but on a 10-year basis, let's work with 3.2. Almost none of these granular pieces of bonds are producing real returns. So once you strip inflation, you're actually going backwards with your money. So even if you don't like equities, you've got to dislike bonds even more. And that's an important point to make, because some of the bigger institutional money flows out there are things like retirement funds, and those type of vehicles are forced to risk up into equities because of this dire backdrop in fixed income. If you're sitting in one of our balanced solutions and wondering, well, what are you guys doing about that? We've reduced our bond exposure as much as possible. So if neutral is 40% for us, we've gone down into the 20s. We've gone slightly overweight equities. So if equities are 60, we've gone sort of 66%. And then we've bought into some alternative assets, uncorrelated assets. And within that fixed income space, we've gone, and without being overly technical, we've reduced duration so that it becomes a lot more cash-like. So the impact of interest rate hikes don't work against your capital as much. So with that sort of backdrop, if you were to give us $100 or 100, and this is really a global market view, if you gave us $100, what would we do with $100 today for the first, or for our Q1 outlook? So in the developed market space, we've moved from marginal overweight positioning to a neutral call there. Within developed markets, we favor the US as well as Europe over Japan and the UK for different reasons. We favor the US because, as I said, it has some earnings momentum that is still in play. And secondly, we do like that quality attribute as a long-term mindset investor. From a European perspective, we think that the economic backdrop for Europe is a lot more favorable. Their need to hike interest rates, etc., is far less. And at the same token, valuations are probably a little bit more attractive. So that's the sort of thinking there, but it's not a only own US and Europe view. We do, in this type of environment, we appreciate diversification, but that's where our overweight tilts are. We've upweighted our emerging market core from neutral to overweight. And in your portfolios here and there, we started to nibble on emerging market opportunities last year. From a timing point of view, yeah, it would have been lovely if we started that at the beginning of this year. But what we started to see was, yes, a higher risk premium to going into the likes of China because of more uncertainty in the way of regulation, etc. But you have to also pair that up against where the valuation was at. We think the valuation baked in more than enough of that uncertainty. On a relative basis, emerging markets looking quite well priced. And then the word catalyst is maybe used sometimes too loosely, but a nice backdrop or tailwind that is starting to play out, and we started to see it as well, is that the Chinese authorities are almost forced this year to start considering loosening monetary policy because we've seen such a slowdown in their growth. So they're coming out with growth numbers of 4.9% that the rest of the world only dreams of, but relative to their trajectory, that's still way off the pace. They targeted 6% growth. And that backdrop is actually physically starting to play out. We've seen the Chinese authorities cut their reserve ratios twice this year, talking about loosening lending criteria to some of the developed property development companies and the banks. So yeah, we think that's a sensible call of almost making the switch from developed markets to emerging markets. I also just want to make it clear that they're by no means going to take your portfolio to 50% emerging markets. I know you've probably externalized your wealth to get out of emerging markets, but we talk about neutral in our minds at around 15% emerging markets, 85% developed. So we're just tilting that dial to around an 80-20 split in the portfolios. We still like listed property. We think it remains a good historical inflation hedge. And we do see economic activity in the first half of this year continuing with its momentum, and listed property is well positioned for that. The risk to listed property is that if interest rates continue to hike up significantly, it works against most of these companies who do use leverage, i.e. they don't take out a home loan, but the same kind of mechanism. What we don't like is sovereign debt, so that very safe debt that we like to park our money in, whether it's German bonds, US treasuries. The payoff profile there relative to the risk just doesn't make sense to us. By way of example, you've probably just gone to a zero interest rate. We were negative interest rates in Germany, i.e. you would give the German authorities money and you would have to pay them every year for 10 years to hold your money there. In the US, you're getting around 1.75%, give or take, per year for the next 10 years to sit there. So we don't think that's a sensible investment strategy relative to inflation. From an investment grade debt perspective, we've also brought that down just because the yield spreads have narrowed quite significantly. So the same argument there, the payoff profile relative to risk doesn't make sense. The flip side is that we actually quite like emerging market debt at the moment. Emerging market debt is actually giving you a real return after inflation. If you look at the South African market, for example, it screams out like a sore thumb. Our bond yields at around 9.5%. The real return after inflation will take 5%. Now, that's partially a function of us having already priced in risk into our market, the Zuma years, the Nene gates, etc. So we've partially priced in the worst, and it's not by no means a risk-free trade, but at least there's a payoff profile that makes sense. And then in our portfolios, we actually hold, I'm talking more the multi-asset portfolios, not the share portfolios, and a neutral call on cash, because cash is there to offset the equity risk in your classic 60-40 portfolio. At least we're not going to lose money on that cash if interest rates go up, and you're not foregoing much yield because you're not getting it in bonds at the moment. So that's our view. And we do this on a quarterly basis. So if you wonder why I always have these long house view videos, this is the final slide that we always try and get to in the back of that. So as I've just spoken about in this presentation, a large part of it was inflation. And I thought it's probably worthwhile for all of us just to discuss what are the things that we can do as portfolio managers to mitigate the risk of inflation in portfolios. So the starting point and probably the most powerful tool that we have is asset allocation, i.e. deciding how much money in proportions of your portfolio we allocate to the various asset classes. And historically speaking, global equities, infrastructure, and real estate investment trusts have held up very well in inflationary environments, where common wisdom often talks about commodities and energy being very reliable inflation hedges. But unfortunately, they are unpredictable. So in certain high inflation environments, like the 1970s and the later 1980s, one or two of those did well, but they've in other environments they've actually lost money for our clients. So we much prefer the idea of global equities, infrastructure, and REITs over commodities and energy. Secondly, and this is common sense, I think as business people on this call, this would make a lot of sense. You want to buy businesses that have pricing power, because ultimately, if you have a business that is able to be relevant regardless of a low or high inflation, you're able to deal with inflation a lot more. So businesses that have strong brands are important, have some monopolistic type pricing power. So again, Microsoft is an example of that. And businesses that have strong margins, that are able to weather that storm and pass on those strong margins to their clients. What you want to avoid in a high inflation environment is market timing. I mean, that's the age-old debate that we all speak about. Terry Smith from Fundsmith always says it very well in my mind. He always says there's two types of investors, those that can't time markets and those that haven't realized yet that they can't time markets. But the point here is, if we look at research on timing markets, it comes out quite strongly. Over the last 30 years, various strategies, market timing actually added to the volatility of your portfolio. And to put a number on it, it increased the volatility in your portfolio by 71%. So try and stay away from doing that. And then secondly, I know I said be long-term focused, but what does that actually mean? Well, if we look at the last 148 years of the S&P 500, your probability of a loss in 1 month is 39%. So your odds are just slightly better than going to the casino with 50-50 odds. But if you hold your portfolio for 20 years, and I do appreciate that is a very long time, but the point is over a 20-year cycle, your probability of a loss is almost zero. It's 0.1%. Hence why we always encourage our clients to improve their odds by staying long-term focused. And then really my final thoughts, and then happy to Giles to field any questions. What we do need to realize is that particularly in developed markets, we've had a fantastic decade of outsized returns relative to longer term market sort of abilities. Local equities over the last 10 years have done 10.7% per year. Global equities have done 12.7%. Local bonds are around 8.2. Global bonds did about 3.8, and local cash, I'm talking about money market funds, etc., did 5.8%. What do we think the next 10 years looks like? Well, we think local equities can do between 9 and 12%. We think global equities, a reasonable expectation is around 4 to 8%, hopefully much closer to the 8%. Local bonds anywhere between 5 and 10, and that will come down to a function of South Africa's sort of trajectory from here. We do know that we have some significant economic challenges as well as political events that we need to get through. But the bull and bear case is around 5 to 10%. Global bonds, we've got 2 to 4. That's our house view, but Rob Enslin on the score, think it's probably even less. I think somewhere closer to sort of 0 to 2. And then local cash, what do we think money markets are likely to achieve? Around 5 to 6% again. So the point is, manage your expectations as clients. Be realistic about what markets are able to do, and 8% type of return in a normal inflation environment of 2 once things settle down is still a significant real growth in your money of around 6%. Secondly, volatility likely to persist. I've said that a few times. So avoid short-termism. And in particular, new clients. I know it can be very uncomfortable if you gave money to us or someone else 3 or 4 months ago, and you're looking at your statement and you're going, "Oh no, I'm down whatever percent." And I'm not overlooking that. I do appreciate that, and that is very uncomfortable. I have my own money, and even that I'm a so-called a professional investor, it does hurt to see your portfolio negative. But try and avoid that short-term mentality, because it will be to your detriment. What I've been encouraging a lot of advisors to do, particularly with the likes of Giles, is to, in this type of environment, it's always a good opportune time to sit with your advisor and reassess your your risk profile. The reality is your risk profile is also dynamic. Your circumstances change, whether it be from a lifestyle perspective, health, whatever it may be. And it's not always a negative. It's sometimes better. You've inheritance, asset swap, selling your business, whatever it may be. But it's a good time to sit with your financial advisor and ensure that you are in a strategy that aligns to your ability and willingness to take risks. Because if you've overextended yourself in this environment, 10 to 1, you're feeling more uncomfortable than you should as we're going through this environment. Avoid market fads. In an environment where money is cheap, and money is cheap because interest rates are at record lows, it's very ripe type of environment for bubbles to form. And when interest rates start to move up, those things that are sometimes excessively priced are found wanting. Now, I'm not suggesting, and I'm not going to have a view on Bitcoin at this point in time, but I'm just saying the fads, unless you really understand them and you get them, by all means. But if you don't understand them and you're just buying them because of the media hype, the type of environment that we're going into is going to catch out some of those opportunities a lot more. So in short, try and avoid satellite strategies because you picked up at a family dinner or you've read in the media. Invest in what you know and invest in things that are actually making money in this type of environment. Communication is essential. So yes, we do produce a weekly newsletter. I think that is sent out to Carrick. If you're not on that, I would encourage you to subscribe to that, because I write it, our CEO writes it, and we really just try and unpack the markets as the day-to-day events as best as possible, our house views. But those medium forms are there, but equally we are absolutely here to answer clients' questions and needs, etc. And then in terms of portfolio, Carrick's approach towards managing their clients' money, I think in this type of environment, Carrick has a competitive advantage because they've made the decision to, and I don't want to use the word outsource, to collaborate with an expertise investment house, as opposed to many advisors out there who follow the dual role of being financial planner, i.e. worrying about your structures, your tax planning, your succession planning, and then after that discussion going and deciding which fund to pick or not. Giles, his day job is to do the former. My job is to ensure that I understand what's going in the markets, understand where the markets are going, and making sure the integrity of the portfolios are positioned for that. So yeah, that's really everything that I have to share tonight. And I'm very happy to answer any questions.
Rob, I think thanks very much for that. I'll open up for questions shortly to everyone on the call. I think just a couple of things that a lot of people are wanting to know, or have certainly sent some requests on, would be something like, what does this mean for the Rand? I know it's not always easy to correlate what the Rand does, but what does this volatility kind of mean for the Rand going forward?
Yeah, so the Rand at the moment, I feel, is sitting on a sort of, it can go either way. And I'll give you the environments where the Rand strengthens and the environments where it comes under pressure. So before I answer that, our view for the Rand, based on our house view, we see the Rand at 15.25 to 16.25 as the sort of upper and lower range. So if you're looking to externalize money and the Rand breaks below 15.25, yes, it could go on to 14.50, but we think as a long-term investor, that's quite an opportune time. And on the flip side, if you were looking to bring money back from, for example, the dollar, anything north of 16.25, we'd argue that the Rand has become overly cheap. So that's how we think about currency. At the moment, the two key drivers, and it's generally always been that, but I think it's amplified in the environment we're in now, is the commodity price cycle, as well as relative interest rates. So on the commodity cycle, the Rand is a net beneficiary of stronger commodity prices. Our economy is very aligned to that and driven by commodities. When commodity prices are high, mining companies mine more, tax collections are better, and then the second round effects of your sort of smaller mining towns, that part of the population gets bonuses, and it's very discretionary in their spending. So you see the likes of Mr. Price of the world, the Fashinis of the world, actually benefiting from a mining cycle as well. What is in play right now, it looked like the mining cycle was sort of losing a little bit of steam because China is going through a bit of a slowdown, but commodities are running red hot again as this year started. And a big driver of that has been partially the inflation concerns, but secondly, some of the tensions that we're seeing in Russia. Funnily enough, that if the worst were to happen in China, in Russia, and we are seeing the sanctions, South Africa is probably a net beneficiary of that, because a lot of the commodities that are available in Russia are equally here. So the likes of your platinum group metals, uraniums, etc. So if, you know, all of a sudden the Russians can't sell, our demand picks up. That's the one. Then secondly, it is a bit of a relative interest rate race. So our South African Reserve Bank is left with a very delicate task of not stunting growth, because our growth, we know, is a challenge in this economy given unemployment, etc. But we also need to somewhat defend the rand, because if you don't, if the US continues to hike interest rates and we do nothing, then for my 100 rand that or let me use a random currency, the pound, I have a choice of placing it in a rand yielding asset or a dollar yielding asset. The relative attractiveness of the US increases. All right, so it's all about the relative attractiveness, and it all comes down to how aggressively our Reserve Bank's going to hike interest rates compared to the US. So those are sort of, both of those can go either direction, I think, from a currency perspective. And then you have to add that South Africa is going into a vulnerable political environment. We've already seen a few shots across the bow with regards to the ANC up and coming election. For now, it's noise, but we know that particularly the last 5 years, the ANC have been under pressure. And if we do see an environment where, because Ramaphosa is considered to be very market friendly, if they do dethrone Ramaphosa, I think the political risk in the investment community would be huge and the rand would come under pressure.
Thanks for that, Rob. And then I think just two more quick questions. With respect to rate hikes, how do you see the midterm elections in November impacting how the Fed implements the hikes?
Yeah, so they are independent bodies, right? They're completely, by design, they are completely independent bodies. So I don't think that's going to have an influence. I think the reality is, and it's been made very clear now, I assume you're talking about the Fed now. Yeah. The Fed's mandate is to create price stability. And maybe what I didn't say on the call, and it is worthwhile mentioning, is that the Fed's objective is to ensure the longevity of the economic cycle. And one of the ways you create an expanded economic cycle is through price stability. So the way I always describe this to my clients is, if you have a daughter and your daughter has married a guy who's very extravagant and spends a lot of money on fancy things, and your daughter is living her best life in her first 5 years, versus the other gentleman who's very prudent and does the right things, but ultimately at retirement, they will live a very comfortable life. I think all of us on this call would probably prefer the prudent gentleman. And so what the Fed is actually doing to us right now is being the prudent gentleman. They're telling us, guys, inflation is running red hot and we need to turn it down. And one of the tools we have to turn it down is inflation. And yes, it's causing a bit of short-term pain, i.e. your daughter's not driving in the fanciest car or living in the nicest neighborhood, but it's a path to ensure that the longevity is there. Yeah, in short, I don't think it's going to have an impact. I think they're independent enough not to be influenced.
Thanks, Rob. That's great. If there's anyone else on the call who'd like to take themselves off mute and ask any questions, welcome to do so now. If there's not, I'm going to go ask Rob one more question, then going to wrap things up. So if there is any questions, please fire away.
Hi, Rob. Henry here.
Hi, Henry.
I just wanted to ask now, with the business cycle, and we're in a little bit of a transitory period, are there any specific sectors which are expected to perform better relatively to others? Which sectors are looking to suffer? And as we are long-term focused here, as we've discussed, how does it affect you?
Yeah, so in our world, what we talk about is sectors that are sensitive to, so one of the ways you value the Fed what you think a company's worth is to discount its future earnings, right? That's the classic DCF that we would have all learned. If interest rates are higher, then you discount those earnings by a higher discount factor, and therefore the fair value is lower. So businesses that fall into that camp where we're looking at really long-term dated earnings projections are your technology and consumer-orientated stocks. And those are exactly the businesses that are under relatively more pressure than others. Whereas your old industry value type businesses that have sort of inflationary mechanisms in them, things like banking stocks, because higher interest rate means that all things equal, a bank is able to have a better sort of gearing because they lend and they borrow, and things like energy companies, oil, because we're seeing the oil price running red hot, are likely to perform. But long term, through an economic cycle, although in the short term period that we're going through now, energy and financials are likely to outperform technology and the likes of consumer orientated stocks. Long term, we think that the sensible approach is to buy businesses with pricing power. So we are thinking about that mix. Am I going to go and buy oil stocks for you? Absolutely not. I think oil stocks are generally very cyclical in nature, and the cycle can turn against you very quickly. They don't meet our quality criteria. From a banking stocks, etc., yeah, we are sniffing around at one or two names that we think might make some sense. They've all come out with disappointing earnings in this last set of results, which gives us an opportunity. But I think the prudent thing to do is, if we've got a 5-year time horizon, regardless of what sector we're in or what industry we're in, is to ensure that the businesses we're in are firstly profitable and secondly have pricing power. And those tend to be the global leader type businesses that you're already in your portfolio.
Thanks for that, Rob. Anyone else got any other questions? I'm mindful of time. We've got 2 minutes left before we need to wrap things up. Derek or Hans, normally you guys have got some questions, but if not, I'll ask the last one. Okay, fine. I think that's it. But Rob, last question. Is now a good time to invest?
Yeah, so the age-old question is when to invest. And I mean, there's certain times to get it a little luckier than others, but the reality is over time it becomes less meaningful. So we've always said to our clients, now is as good as time as ever to invest, because the reality is one factor that we have in our favor is time. So the more time you give your investment, the better you improve your odds. So for those clients who've waited on the sidelines for 3 years for the opportune moment to get involved, you've forgone 3 years of opportunity. And the point I try to make on the previous slide, the longer you stay invested, the improved odds you receive. So yeah, I think if your long-term financial goals are X and you've spoken with your financial advisor and that makes sense, then the quicker you start applying to those long-term goals, the better. If your mindset is to try and make money in 3 months or 6 months, then absolutely market timing becomes an important ingredient, but we would argue no one has that ability to perfectly time markets, so try and avoid it.
Great, Rob. Thank you very much. I really do appreciate your time, and thank you to everyone on the call. I do appreciate your time. I hope it was insightful. If there are any questions, or if you do want to have further discussions, you know where to find me. And if you need to have further discussions with Rob, certainly something we can arrange. So Rob, thank you very much. And thank you to everyone on the call this evening. I hope you have an enjoyable evening. Thanks very much.